So good afternoon, everyone. It's really a pleasure to be here with you. We have 4 wonderful panelists today to talk about crowdfunding. I don't know how many of you in the audience have even been a crowdfunder yourself, have given money to whether it's philanthropic organizations through Kiva or Indiegogo or Kickstarter or any of those. But we're going to talk about crowdfunding today from the financial platform side. So I'm going to go right in to introduce our panelists to you, and then they'll each have a few words with you. Over here to my right is Luan Cox, who is the co-founder and the CEO of Crowdnetic. Crowdnetic provides technology and data infrastructure for crowd finance, serving both the equity and the lending markets. And next to her, Chance Barnett. Chance is the founder and the CEO of Crowdfunder. And he'll be talking more about how he connects entrepreneurs and investors through the Crowdfunder platform. Next to him, we have Katie Fitzgerald. Katie is with CircleUp, and that's a little different position in the funding marketplace for consumer products, which is generally something that the venture capital market is not funding today, and CircleUp has found a way to do that. And over on the far side here, we have Mike Millman, who is the recently promoted head of, and the co-head of equity capital markets for JP Morgan. And he'll probably have the view from the top of the funding markets. So let's start with Luan. Luan.
Thank you, Kay, and thank you, everyone. Good to be here. Everyone can hear me okay? Yeah, so just some background on Crowdnetic, and then also just maybe 30 seconds on the regulatory environment. We started our company 3 years ago, pre-Jobs Act, and got very involved in working with folks like Chance when the Jobs Act started to bubble up, and pivoted our company away from being a rewards-based portal into doing what we know best, which is building market data infrastructure. So for the past 2 years, we've been tracking all kinds of data. When the Jobs Act, right now, as you know, the Jobs Act has sort of 2 parts of it that are relevant for us. Title II, which was implemented on September 23rd, which removed the general solicitation ban. Crowdnetic partnered with AngelList, Crowdfunder, EquityNet, all of the leading crowdfunding portals who are publishing in real time all of their data. And today we're seeing about 3,300 companies that are publicly raising, private companies publicly raising online. And we can talk more about that later. Title III obviously is still up for debate, and David Wield will talk about that more after our panel. But obviously we're sitting with Jobs Act 2.0 for crowdfunding, and stay tuned for that. So I think today we'll focus on accredited investor crowdfunding.
I just want to have a show of hands with people in the audience. How many in the audience know about the Jobs Act? And is it something that's familiar to most people in the audience? It really is a way to democratize capital and bring more capital to the marketplace through funding platforms. But there are 3 different titles, and the first one being for IPOs, Title I. The second one for accredited investors, Title II. And Title III is for unaccredited investors, where people can put smaller amounts of money into the market. And that is yet to be regulated fully for the marketplace. So, Chance.
Hi, I'm Chance Barnett, CEO of Crowdfunder. I'm here, and I started the company. I was an entrepreneur several times over, and then an angel investor and an early stage advisor. And I got involved in Jobs Act legislation and then subsequent regulatory dealings with the SEC and others. What's really interesting happening today, we're seeing a variety of accredited investors. That includes individuals, active angel investors or angel groups, and venture funds really use the web to start to source deal flow, to get data about investors, and to actually make investments, oftentimes knowing more about who's invested and the potential relationships that surround the company than they might have had they just gotten a pitch deck emailed to them. So my role in that has been, over the last 3.5 years, founding Crowdfunder, I also was a writer for Forbes on startups, angel investing, and the Jobs Act during that period to kind of have a journal of what's going on in the space, how the public, how regulators are arguing about how this will succeed or fail, and I think they're both right, and we can maybe get into that. And I've been an active investor myself, so for me, this is kind of the dual play. I get to really help entrepreneurs, which is something I love, and then I get to also put on my investor hat. And I think that's what's unique about what's coming in the near future as we potentially open up investing to everyday citizens, not just the wealthier people. Is that if you want to own a piece of your block, the restaurant down the street, or you want to put $500 or $1,000 into the latest interesting potential big next thing that's a technology startup, you'll finally have that opportunity, not just venture capitalists. And there's risks and there's problems, but this will play out in a significant way, and I think bring a whole new asset class up for grabs, and also bring a whole new class of investor. So that's part of what we're talking about here at Exponential Finance.
Great. Katie.
Good afternoon, everyone. Thanks, Kay. And first, thanks Singularity for putting on such a great event, and I'm honored to be a part of it. CircleUp, I'm Katie Fitzgerald with CircleUp, and we are an online investment platform connecting consumer product and retail companies with accredited investors. We launched in April of 2012, and we've helped 40 companies raise $40 million in aggregate. Through our platform, consumer entrepreneurs can access capital more efficiently and in a way that they couldn't previously. And investors can access curated deal flow and a more efficient, transparent, and convenient investment process. We are backed by Canaan Partners, Union Square Ventures, and Google Ventures ourselves. And again, we focus exclusively on equity-based crowdfunding and helping those earlier stage consumer product companies access capital.
Great. Mike.
Great. Thank you, Kay. Mike Millman, JP Morgan. As Kay mentioned, I'm now responsible for overseeing, with my partner Jeff Zakowski, our capital markets business and equities for North and South America. You know, this year we've had the pleasure of executing over 120 deals, raising $50 billion this year. So what I'll bring to bear, and hopefully the panel today, is the value that crowdfunding plays in our overall ecosystem. You know, from our perspective, it plays an invaluable role. Crowdfunding allows the feeder to IPOs in a manner that we didn't have historically, and I think that process will be invaluable as we look over the next decade of potential public companies. As you heard from the prior speaker, you know, the markets today have 5,000 publicly traded companies, but in order for that to continue on a great trajectory, crowdfunding will play a critical role. And so as we sit here today, it's a vibrant market in the equity capital markets. We have had this year tremendous activity. So in IPOs, we've had about 120 on the street. They have raised nearly $25 billion, just IPOs, all sectors year to date. On average, they're trading up 18%, so well above the market at 5%. And so the asset class is working, the market's at an all-time high, and it's a perfect time for this panel.
Thank you. Well, Luan, I want to start with you because before we had crowdfunding, we had people raise money in closed circles. You had to know who the people you were talking about, they had to be accredited, and I think people in the room know what accredited investors are, but in case you don't, you have to have $200,000 a year in annual revenue or $300,000 a year annually if you're married or partnered, have partners, or $1 million in net assets, and those are what accredited investors are today. But let me ask you the question about transparency, because what crowdfunding does is really kind of open up the market for transparency for people to look in and find out a lot more information. So tell us a little bit about that.
Sure, Kay. Yeah, I mean, in my mind, what's happening now, thanks to Title II, is akin to what happened, you know, in the 90s with the advent of self-directed investing and Wall Street quality sort of information coming online. And all of a sudden, we didn't look at the newspaper anymore or call a broker. All of this information was available. So what was sort of private in the 90s became very public. And I was involved in helping to build companies in that time. Same thing now. On September 23rd, you know, 3,000 companies checked the box that they wanted to advertise their offering on Facebook, on Twitter, and it's sort of chaotic. So, you know, one of the reasons why we exist and proud to exist is because, you know, this is a new asset class. And when you have real investors, accredited or not, looking at possible investments, a data infrastructure, data taxonomy, identifiers like QSIPs need to be created, and we've done that. And the concept is that, not just here, but globally, we've got to address this problem, because if investors are now viewing, whether they know it or not, private offerings side by side public. And it's very confusing. And we've actually, I think, either helped or hurt that confusion. We actually launched in partnership with Dow Jones on MarketWatch.com in October of last year, the first ever sort of private company quote feed. So you literally, on MarketWatch.com, can see stocks, bonds, ETFs, private securities. So yeah, transparency is often overused, but in this case, when a new asset class is born, anyone in the data and financial services industry knows, technology and data companies have to come to the rescue. So
people can track today publicly through Crowdnetic.
Well, yeah, I mean, we're talking about thousands of portals globally. What we've created, and you know, we partner with other companies too to build this. But where you literally can go on and search for high-tech companies in Southern California trying to raise $2 million at a $10 million market cap using convertible debt across all portals, and that's important.
So, Katie, I want to move to you next, because you have CircleUp has a little different perspective on the marketplace, looking at consumer products, which really were not in the funding of venture or even a lot of private equity funds at all. Let's talk a little bit about what you're doing in the consumer products market.
Sure. So consumer product and retail companies below 10 million in revenue have historically had a really challenging time raising capital. And that's because that industry lacks the venture community that a lot of other industries benefit from, like technology. So we focus on that industry because there's less of a selection risk to our investors. We aren't competing with the venture capital firms and the institutional firms that are looking to invest in these companies because they're not active there. So we can focus on finding high-quality consumer product and retail companies and presenting those companies to our investors. We also like consumer because it's more tangible. And in making an investment decision, it's critical that you understand the underlying business model. I know everyone here in this room, or most people here in this room, have a deep understanding of technology. I think that's clear given all the presentations today on robots and predictive models, but the average person doesn't have that understanding. But everyone is a consumer. So we find that it to be an attractive industry for this type of model, and for that reason, as well as for the funding gap.
So Chance, on Crowdfunder, it'd be very, I think, interesting to people in the room is what people who come, the companies that come to raise funds with you, what do you offer them in terms of what they have to know in order to be successful raising funds on a platform like this?
Sure. Well, I think this is the new opportunity for them. If you, like Luan said, if you haven't come from an area or background where you don't have a large network of high net worth individuals around you, it's fairly challenging, even if your company's doing well. That said, what we're seeing now in growth is the building of networks that create a much more efficient distribution channel to high net worth individuals and everyday investors.
So give us an example of a very successful fundraise on Crowdfunder.
Currently, we have a company that was backed by Sequoia Ventures. So we actually have a variety of deals that do have traditional VC companies in at the seed and Series A stage. Rather than just have Sequoia take down their entire round, a variety of the investors actually thought crowdfunding was a great idea because they wanted to build the momentum, tell the story, and give a larger community the opportunity to invest in the company. So what we're seeing is one of the things that helps drive great outcomes is a notable first or lead investor. And in fact, the data shows us that those get 6.5 times the amount of engagement as someone who doesn't have that. So that's a really great thing that is driving good outcomes. The challenge there is that that's not transformative access to capital truly. I see that as incremental growth. If you can get a lead investor, great, you'll probably get some follow-on. Where I think it becomes really transformative in the future is when the capacity is built on networks like Crowdfunder, where we have about 60,000 investors and entrepreneurs to take someone from 0 to 100 miles an hour, not from 60 to 100 miles an hour. And we're getting there.
Well, I think that, we're talking about crowdfunding, and a lot of people think of it as sort of like the startup part of the marketplace, but here you're offering it as additive to Series A or even Series B funding. It could be additive to it. But Mike, from your point of view, looking at it at the capital markets, really at the larger scale capital markets, how do you see crowdfunding being talked about, or accepted, or rejected by that marketplace?
We embrace everyone.
So friendly.
We'd like to be warm at JP Morgan. The capital markets, I think, had been looking for an opportunity that I think crowdfunding provides, which is to help fund early entrepreneurs and their endeavors going forward. And I think if you look at it holistically, you're seeing a lot of institutional investors come downstream, investing in later stage opportunities just before an IPO. So large mutual fund complexes, hedge funds coming downstream. You have venture capitalists that are going both slightly downstream and more upstream. But we really haven't had an opportunity before this innovative approach to capital raising to really fund early companies at such a broad scale. And I think it's going to be an incredible mechanism as we look down the road in capital markets.
So, Luan, going back to you for a moment, what do you see as the banks or other institutions being influenced by or affected by crowdfunding?
Yeah, I mean, I think we are still early, but early on, they definitely weren't afraid or didn't pay attention, and now I think it's definitely changed, in large part by also the peer-to-peer lending space as well, and the validation that's gotten, and that's obviously a 7-year-old industry now, so we see sort of the equity side following that. But with respect to banks and brokerages, I mean, we see a future where they're either partnering with viable crowdfunding sites and/or implementing crowdfunding technology within the institution, because clearly they have sort of the two golden eggs, which is people who need money and people who have money to invest. So rather than lose those assets to my friends here on stage, they'll rather partner or potentially compete. And I think that's where we're headed with that. I think with respect to brokers specifically, I've always believed that there will be a day when Schwab E-Trade Fidelity will wake up and say, wait a minute, I want to offer private securities. And maybe there might be baskets of them and funds of them. They might not be single securities, but certainly private securities will be offered as another asset class to individual investors.
Secondary markets, Mike, really brings up an issue that Luan just mentioned in terms of the secondary markets for people being able to trade out securities before they're public. What are your point of view on what has developed?
Yeah, I think it's still evolving. Secondary markets, I think, had played a valuable role at different points of time over the last few years. I think if that market evolves, I think it'll be a very fruitful opportunity for investors to go from just before a company goes public to an IPO, or just before a company may go public in a sale. I think those markets need to continue to evolve to be successful. I think transparency and liquidity are critical for their success, and I'm optimistic that hopefully we'll see that business bloom.
And I'm going to argue with you. Just kidding.
Please.
Go right ahead.
No, I'm not.
We already argued beforehand.
Yes, transparency, liquidity. I think my personal opinion is that the secondary market for private securities, the companies may not want to go. There might not be a need to go public. Is my point. And we're seeing that again, an emergence of secondary or liquidity needed in the peer lending space, and the equity side is going to follow. And is it really necessary for a company to go public to get that liquidity, or can we just trade? And we've seen predecessors like Second Market and Shares Post, but there's going to be a new private-public market.
So the crowdfunding site, Crowdfunder, has been up and operating in this marketplace. You started 3 years ago, Chance, but what are you seeing in terms of, it sounds always good to people say, well, I'm going to go crowdfund, I'm going to do this, but we know that every company that comes to crowdfund doesn't doesn't achieve success. What kind of ratio of success are you seeing in this early stage of companies coming to raise funds there and actually achieving that in the period of time they set out to raise funds?
So right now we drive in some level of investment into about 12.5% of the companies that come to our platform. That can be as little as, say, $5,000 or $10,000 today, which I also think is a really important piece of the puzzle that we're flirting with here. But we've helped close in just over 2 quarters about 25 seed and Series A deals. And within that, generally those have closed in a closer to 45-day period. So what we're seeing is the ability for an entrepreneur who's come onto our platform where it might have taken them 3 months to meet a variety of the investors and then start the pitch process and pound the pavement, to do that and effectively raise money from really strategic investors. One company, we helped them get $600,000 in 4 hours. Those investors all committed with $300K of that actually in the bank in 2 days. So I've never heard of anything that fast until crowdfunding came along.
Right.
And what we're finding is the quality of those investors, while some people anticipated you're out on the web, you're just going to have a bunch of dumb money, in multiple outcomes of those 25 seed and Series A deals, they've actually made a variety of those investors advisors as well. So they're strategic money. So what we're finding is people are out there looking for deals, looking to be a value add, and writing checks as big as 100 to 500K. And those are just the individual investors. There's relationships being built with funds as well that are looking to write bigger checks. Where I think this becomes really transformative and we experience exponential growth is in 2 areas. What happens when you bring non-accredited investors into the market? That's a new class of investors. There's $32 trillion in personal savings and investment accounts that generally don't touch the early stage business market. So what crowdfunding and Title III has the potential to do is bring a very small portion of that into the market. If you got 1%, which is the entrepreneur's terrible pitch that I don't want to give right now, if you got 1% of that market to invest in crowdfunding, it would be a $300 billion a year investment. The current venture capital market for scope is $30 billion a year, so 10 times the size of the current VC market. I'm not saying that's happening, I'm saying that's the potential for exponential growth over time. And just one last point, what happens when you lower a minimum investment into a Series A company or a seed investment from what traditionally has been among angels and individuals of, say, $50,000 or $100,000, and you get it down to $1,000 or $500? We've done a lot of surveys of investors, and we found these really interesting risk inflection points at about $10,000 and at about $1,000. And when you get investment at that level, people become really interested. The reasons for investment change a little bit, and they're really interested in diversifying. So that's where I think we're going to see some of the innovation and real exponential growth.
So Katie, CircleUp just launched a new funding process this week, I think you said. So would you like to talk a little bit about what you're doing in that marketplace for raising funds?
Sure. So we launched a new product called Circles, which allows investors in the industry that we know that are active in the space to actually raise a fund from our investors, and those funds will then be deployed across companies raising capital on the platform. We also have thematic-based funds, so if you're an investor and you're looking to diversify across earlier stage consumer companies in natural and organic products, then you can invest as little as $10,000 for no fee and no carry on the theme-based funds. And then we have the externally managed funds, which again is us allowing lead investors to raise a fund and then deploy those funds in a 0% management fee and a 20% carry in most cases. But again, it allows for investors to access a new product, invest and diversify across earlier stage consumer. And in the case of externally managed funds, actually invest behind investors that are active in the space.
Thank you. Mike, we often talk in the industry a little bit about what happens to the cap table when you do crowdfunding, which is new to the marketplace, and as it goes toward the IPO market. Do you have a point of view on how the cap table changes or changes you might be expecting in cap tables as they come to the IPO market?
So anytime we talk about cap tables, I typically call my life coach to talk about it. It's a complicated topic. The cap table work that gets done to get a company ready to go public, obviously is extensive. We would need, most cases, to find those shareholders and convince them that they should lock up their shares for 6 months. So we have to go deep in the cap table in order to make sure that new investors in an IPO feel comfortable that there won't be this unquantifiable amount of selling that happens on the first day a company's public. So we go down and try to lock up as many of those shareholders as possible. I think the more complex and the deeper those shareholders' rosters are, the more difficult that process and exercise will be. But with the right systems in place, I think we can accomplish our joint goal of making sure we have new shareholders comfortable that the current shareholders won't be exiting en masse on day one, and therefore we'd have a productive capital markets like we do today.
Right. Chance.
So just to add into that, there's a supposed problem and a real problem in crowdfunding. If you imagine suddenly going from, say, having 5 venture investors or 1 venture investor to potentially 300 or 400 investors. What we do to solve that problem for companies that are interested in creating, and it's not a requirement with Crowdfunder, is creating an SPV, a single purpose fund that it's a fancy name for an LLC that houses all of those investors. That does the work of making it easy to lower the minimum investment and spread that across hundreds of people and contain them in one entity that then invests as one entity on the cap table. So you're not carrying around 300 people on your cap table, and it's managed by us or, say, a lead investor. And so that keeps things more clean and slightly separated. And so we found that as an elegant solution to some of the problems here.
I think, Luan, you have some comments
Sorry,
with. Oh, you like that?
I was just clapping on the idea.
Oh, okay, right. I mean, I think you had some comments too about what you were seeing on, cap table changes in the marketplace. And people have asked me on the, the venture side when they're coming behind crowdfunding, different questions about how the cap table is being perceived. And I think the special purpose fund that has one investor is really resonating with people because it's much simpler to deal with. But what are you seeing across the board?
Well, yeah, I mean, I think that's the future, and that's what should be done. I mean, I think that more than anything, we've got an ecosystem that the most exciting thing about what's happening is we've got an ecosystem, a true ecosystem for a company to form and to get funded. And it starts from, Kickstarter, Indiegogo, and getting your product validated, to the peer-to-business small loan space where you get a $35,000 loan from Lending Club for seed capital, and then you go to the equity world and raise your growth capital, and then you come back around to the peer world, to an on deck, and get your operating capital because you have revenue. And so we've literally created an entire ecosystem. And guess what I didn't say? I didn't say words like JP Morgan or Bank of America. Mm-hmm. It's Crowdfunder, it's CircleUp, it's Lending Club, it's Prosper. So it's exciting, and I'm honored to be a part of it.
Well, I think that's a good way to end this panel. Thank Luan, Chance, Katie, and Mike. Thank you very much.
Thank you.